Alright, so this is going to be an introduction to futures trading for beginners. And by the end of this talk, you'll be able to understand how the futures market work. And if you're new here, I'm an award-winning trader, ranked number one in Singapore in a trading championship. And I graduated with a finance degree, and I've been a speaker for various financial conferences over the past 10 years. So the first thing you gotta do is to start with a demo account after you have learned everything you need to learn today to practice for at least 6 months. Okay, give yourself at least 6 months. Patience is the key to success in trading, and then learn about the specific market you want to trade because futures you can trade a lot of different instruments. Later I'll get into that. And also, make sure you select a good futures broker. And as a beginner, start with E-minis and E-micros. Later, I'll get into what is an E-mini and E-micro. And if you have no capital, for those who have no capital or want to use other people's money, as Robert Kiyosaki says, then you can get funded with a futures prop trading firm. After this slide, I'll share with you what firm do I recommend. And of course, practice very good risk management, use a stop loss order, limit leverage. Now, even though futures allow you to leverage, but I don't want you to go all the way because leverage is what kills a lot of beginner traders. Monitor margin closely. Later, I'll talk about margin too for futures. And also master trading psychology. This is a very important skill. After this whole entire course, just go through my trading psychology videos and also how to craft a trading plan as well as trading journal. I have videos on that too. After this course, you can go and watch it. So a bit of disclaimer, make sure you pause the video and read this before we move on. And a prop trading firm that you can consider is Apex Trader Funding. And Apex Trader Funding has been giving payouts to traders all around the world for the past few years. And I've met their team, talked to them, make sure that they pay out to their traders. And so far, for the past 90 days, they have paid out more than 58 million to traders all around the world. You can go to their Instagram and check the testimonials because you'll see a lot of people there talking about receiving their payouts. And Apex Trader has been around since 2021 and they have traders all around the world from over 150 countries and they are headquartered in Austin, Texas. And some of the accounts that you can trade with, you can go to products over here. Then you have the Tradeovate and Rhythmic account. You pick the one that fits your overall goals and risk appetite, okay, because they have different plans all the way from 25,000 all the way up to six figures until 300,000. So if you want to sign up for this prop trading firm, I'll put link down in the description below as well as in the pinned comment. Now, so basically, what are futures? If you have watched my previous introduction video, I mentioned that they are standardized contracts. Now, if you trade Forex, you know how much is one standard lot, how many units is one mini lot, one micro lot. Whereas for futures, there are weird numbers associated with certain currency pairs. So later I'll share with you what I mean by this, okay? But for now, just understand that they are standardized contracts to buy or sell an asset at a predetermined price on a specific date in the future. If you go to finance school, you have to study a whole module that is only about derivatives. I took this module back in my finance degree stint, and it was actually the hardest module because a lot of students failed. But thankfully, I studied hard and passed. Because derivatives, you have futures as well as options, and it's a lot of calculation that you need to do. But because this course is for beginners, let's make it simple. I'm not going to go into calculations for now. So just like any contract, a futures contract is an agreement. So it's just like you and the seller just sign a paper, a piece of paper, and then that's it. Today. There's no exchange of products. You just sign a contract today. That's it. So futures are standardized by exchanges, primarily the CME. Now, as a futures trader, this is the website you need to pay attention to, the CME website. Later, I'll share with you what kind of details you need to take note of when you go to the CME website. So contracts are standardized according to delivery points of interest, quality, quantity, time of making a delivery. So why is it called derivatives? So let's say if you buy a car today and you sign a contract, that contract itself, the underlying asset is the car. Okay? So basically, the car is the underlying asset, and then the piece of paper, the car title, the number that you get just grants you a legal claim to the car. That piece of paper just allows you to own it. So this is what futures contracts are all about. It allows you to own it. So basically, a futures contract is an obligation, not an asset. Okay? It's an obligation, not an asset. So in a way, they are considered liabilities rather than actual assets. And to put in simple terms, basically, you're entering into a contract today to buy or sell an asset in the future. Okay, so the difference between spot forex, let's say you trade forex, okay? Difference between spot forex and futures. One of the main difference is that for spot forex, because everything is done online, or people call it OTC, over the counter, so there's no volume data. Whereas for futures, because it is traded on an exchange, so you can see the volume and open interest data very, very clearly. Okay. So if you are still not clear about my explanation just now, let me just go into a very simple story. Okay. So let's say you and your friend love apples. Okay. And your friend says, I want to buy apples from you 1 month from now. 1 month from now, I want to buy apples from you. Let's agree on this today because I don't want to pay a higher price next month in case apple prices go up. So both of you enter into an agreement. Okay, sure. In 1 month's time, I'll sell you an apple for $1 each. Okay. And I'll sell you 10 apples. So you both shake hands and sign some form of contract or just a verbal agreement. So this is essentially a futures contract. And when it comes to futures contract, you often see this delivery date. What does it mean? To put in simple terms, is when your friend gives you the apple in 1 month's time. That's the delivery date. Okay. So it's kind of like getting your shopping parcel. Delivery date. Expiration date, you also see this term a lot. Basically, it's 1 month from now. Okay. So you can see how a lot of people in our society can take advantage of this agreement. Basically, you'll see a lot of companies, okay, MNC companies, they would buy futures to hedge against currency risk. Okay, so you see a lot of MNCs. They engage in the futures markets, especially currency futures, not to speculate forex, but to hedge against currency risk. And also for farmers, let's say if you're a farmer and you decide to harvest your crops, but then just nice on the day you harvest your crop, the price drop, and then you are going to earn very little money. So in order to prevent that as a farmer, you gotta go into a futures contract to hedge against the risk. So let's say you know that okay, in September you're going to harvest your crops, but now it's April. So right now you would sell September futures so that in the event during September harvest time the prices go down, you will be able to use the profits to cover the decrease in prices of your fruits. But let's say you're a fruit supplier and you want to buy fruits from this farmer. So what do? What if the price goes up in September and then I'm going to pay more money during the harvest month? I'm not going to wait until September. So I'm going to buy September futures just in case September the fruit prices go up. So if in September the fruit prices go up, you can use these profits to cover up the increase in fruit prices. So to put in simple terms, what I've explained to you, when you buy a futures position, then you are going on a long position. Okay. So basically you commit to buy an asset on a future date, like I've explained just now. And when you short the position, just like the farmer, you commit to sell an asset on a future date. Now, as a beginner, you can understand that shorting futures is not such a smart thing to do because it's just like shorting a stock. The lowest it can go is zero, right? But the upside is unlimited, especially when you're shorting a stock. So as a beginner, try not to engage in shorting futures for now, unless you know what you're doing in the future. So why trade futures? Like I mentioned just now, it allows you to hedge, manage your risk in volatile markets, also allow you to diversify your asset portfolio. Let's say you only invest in stocks or you only trade forex. You can add futures as a form of diversification. Now you can understand that for diversification to work, the asset classes have to be uncorrelated to each other. Okay? Because if everything is correlated, positively correlated, then if one asset goes up, then all the other is going to follow, then there's no point diversifying. Okay? And the good thing is that you have high trading volume. Also depends on the asset that you trade. It also gives you leverage. And remember, don't use all the leverage that is given to you. I've seen more people blow their account by over leveraging than becoming millionaires because they over leverage. Now, aside from hedging, what you can do with futures, of course, is to trade it, to speculate in it. So, when you're speculating, you are not investing. So, you can understand that, okay? When you're speculating in futures or options, it's not like you're buying bonds or shares because for futures and options, they are not long term investments which would give you income, regular income. Because futures and options, they don't pay no dividends or interest. Okay? So as a futures trader, you can understand how to read the quotes. So when you go to the CME website, which is a website that you should use as a futures trader, you come across this table. So basically, let's go through one by one. What does it mean? On the left column over here, you see month. Basically, it's the contract month. February 2025 means that the contract is going to expire at February 2025. And 6E over here, that is like the product code or the contract code for the standard Euro contract. Okay, because right here we are looking at Euro FX futures. So it's kind of like the ticker symbol to put it in simple terms. Because when you type 6E into your trading platform, then you can get the chart. So treat it like a ticker symbol for a stock. And the final number over here, 5, it just represents 2025. Okay. Second column, options. So when you see OPT over here, means that there are options available for this contract. If you trade options, then you know that, oh, okay, I can trade options on this contract. And then the third column, chart, basically when you click into it, you can look at the futures chart. Last column over here, 1.05075 is the most recent price that is quoted. And the change, it comes in the form of units as well as percentage. Basically, it's the difference between the most recent trade price and the prior settlement price. To put in simple terms, it's the change of the new price from the last price. Prior settle, you can see it's blank over here. Basically, it's the settlement price from the previous trading session, and it's blank over here because it is for new data updates. Okay, don't need to care about it for now because I don't want to confuse you too much. Open, high, low, quite similar to your spot forex. Basically, it's the price at which the contract is traded at when the market open for that session. And during that whole entire session, highest price it went to is this 1.05295, and the lowest it went to was 1.0426. And volume over here is the total number of contracts traded on that day. Basically, it's the total number of contracts traded during the session. And last column, you have this updated column over here. Basically, it's the timestamp telling you when did they last updated this data. that you are seeing here. Okay, let's go to the key components of futures contracts. So when you go to the CME website, you will see a lot of details and jargons that you might not understand. So let's go through them one by one. You'll see underlying asset, contract size, expiration date, delivery date. You'll see the price, price limits, margin requirements, mark to market, futures exchange. Okay, so when it comes to futures, you can trade any specific asset that you prefer. You can trade commodities futures like oil futures, soybean futures. You can trade stock market futures, indices. You can trade forex futures, currency futures, and even interest rate futures. So you can see over here, you have stock futures, currency futures, index futures, commodity futures, interest rate futures. So the oldest asset would be commodity futures because it has been traded for many, many centuries. So that's why nowadays people just classify it based on two types: commodity futures as well as financial futures, which include all your stock futures, currency futures, index futures. And even though financial futures, they are relatively new as compared to commodity futures, but they now account for about two-thirds of all the futures traded in the US. So it's quite substantial. And nowadays, investors, they even go to the extent of purchasing options on futures contracts. So that's a little bit more complicated. So when you buy a stock market index future, you can use it to hedge your investments in the stock market. Whereas for interest rate futures, they are quite in demand now too because investors, they want to protect themselves against any crazy movements in the interest rates. So if you want to hedge against interest rate movements, then you can consider interest rate futures. Because if you studied my intermarket analysis videos, you understand that interest rates has a very close correlation with bond prices. So if you're into bonds as well, then you can also consider interest rate futures. So one of the main things you'll come across when you go to the CME website is contract size, okay? And basically it's the standardized quantity of the underlying asset covered by the contract. So a futures contract, they are going to specify how much of an asset must be delivered. And for financial futures, they are specified in monetary terms. For commodity futures, they are specified by weight, quantity, as well as quality. For financial futures like currencies, stocks, there's not going to be any quality standards because for commodities, when you get into a contract, there's going to be a physical delivery. So, hence, the quality of the crops, the commodity has to be very good. Okay, so when you go to the CME website, when you go to the Euro FX futures contracts, you need to click on specs, okay, and then you'll be able to see all the contract specifications. So you can see over here, one standard contract for Euro FX is set at 125,000. Okay, so you see it's very different as compared to spot forex, where one standard lot is 100,000 units, whereas for FX futures, they have different numbers and just like weird numbers. So don't think too much about why is it that number, just follow whatever that is specified, okay? And you also have price quotation. It's quoted in US dollars. Also check the trading hours based on the time frame that you're trading at. You can also see minimum price fluctuations, okay? So when you're trading a futures contract, no matter what the underlying asset is, make sure you check the specs. And you are gonna understand that when you hold a euro position, until the expiration date, you will actually get physical delivery of euros from the CME. So that's why a lot of traders, what they will do is that 1 week before the contract dies out, they are going to start trading the next month contract. So basically, you gotta close it out and then you roll yourself over to the next quarter's contract. Basically, it's what we call a rollover. Now, just now I mentioned that as a beginner, you gotta start with e-mini contracts as well as e-micro contracts. Because sometimes standard contracts is a little bit too much for beginner traders, especially those who don't have enough capital. Okay, basically they are smaller sized futures contracts, and they have a smaller notional value. It's a fraction of the size of standard contracts, and it has lower margin requirements and hence more accessible for retail traders who don't have a lot of capital to start with, ideal for smaller accounts and beginner traders, and provides exposure to major markets without large capital. Okay, so for Euro E-mini, instead of 125,000, right now it is only 62,500 units of Euro. And if you look at other contracts, they may have different sizes. Doesn't mean that all E-mini contracts is the same number. So that's why I tell you, before you trade a futures contract, you gotta look at their specific specs. And E-minis are quite popular nowadays because of the liquidity as well as tighter spreads, and the margin requirements are less than standard contracts. So some of the popular E-mini futures, you have S&P 500, ticker symbol ES. Basically, the S&P 500 is a very popular E-mini contract, as well as Nasdaq 100. Okay, and this is the ticker symbol NQ. Okay, let's go to E-micro contracts. Basically, it is even smaller than E-mini contracts, designed for even lower risk and capital requirements, and is 10%, 1/10 of the E-mini contract size, and is great for precise position sizing, allow beginner traders to start small while learning. So you can use E-mini contracts to test out your trading strategy and practice how to trade live with futures. Basically, E-micros, they are a great way for traders to reduce their losses by trading with less, and it also makes everything more affordable for new traders. So some of the popular E-mini contracts, you have Micro E-mini S&P 500 Index Futures, ticker symbol MES, as well as E-mini DJIA Index Futures, ticker symbol MYM. Aside from that, there are also E-micro futures for Russell 2000, for S&P 500, and some of these can be good alternatives to your currency trading strategy and allows you to be more diversified. Okay, delivery date. Basically, it's the date when the underlying asset is delivered or settled, and it occurs after the expiration date during a specified delivery window. Varies by contract. Again, check the specs outlined in the exchange. For cash settled contracts, you can skip this step, and the delivery period is usually standardized on a short term basis and can range from 1 month, 2 months, 3 months, or 6 months. And long term contracts are also available, usually longer than 1 year period. So basically, most traders, what they'll do in order to avoid delivery is to close the positions before expiration date. And trading in a contract will cease on or before the delivery date. So expiration date is the date in which the contract expires, requiring settlement or closure of the position. Basically, it's the last valid day of the futures contract, and it determines when trading in the contract ends. So, like I said just now, the traders typically close or roll over positions before this date. So, if you are confused as to the difference between delivery day and expiration day, basically, delivery day is when the physical delivery is going to happen, whereas for expiration day, it simply refers to the day in which the contract ends. And you can see the settlement type, settlement day, in your trading platform. And over here, I have investing.com. It's a free website. You can see over here settlement type, physical delivery, settlement day. Basically, physical delivery refers to the actual delivery of the underlying asset. You will receive the physical currency, physical product. Whereas for cash settlement, it's settled based on price difference without physical delivery. Because when it comes to buying a futures contract, you are buying the right to own this for 3 months. Basically, it's a quarterly cycle. So if you hold on to it, you're going to get the actual currency. And when you look at futures tables, like what I showed you just now, you see the price. And the price quoted is actually called delivery or strike price. When you study finance in school, okay, when you calculate all the formula, normally we will refer it as strike price. Basically, it's the agreed upon price for buying or selling the underlying asset. And also, when you study finance, you come across this graph. Okay, this one is the delivery price. It's stated as K, but to put in simple terms, if you go on a long position, you will make money if the spot price is higher than the delivery price. You are going to make money when the spot price is higher than the delivery price. And it's just like your spot trading, forex trading. If you go into a long position, you will lose money if the spot price is lower than the delivery price. But the loss is limited to K. Whereas if you have a short position, you will make money if the spot price is lower than the delivery price. Okay. And like I said just now, unlike the long position, the losses for a short position, there's no limits. So basically, shorting futures is riskier than buying futures. So as a beginner, even for experienced traders, try not to short futures because the risk to reward doesn't make any sense. Okay, price limit is the minimum price movement for the contract. And for futures, we use the term take or point. So for Forex, you would use pips to refer the smallest unit of the price movement, but for futures, we use ticks. It's basically the same thing. And position limits. Now, when it comes to futures contracts, a lot of contracts they would specify daily limits for price changes to avoid super volatile price swings because the exchange have to impose limits on the number of contracts a speculator may hold to prevent them from owning a big amount of open contracts, which will cause them to be able to manipulate the price. Unless they are hedging the markets, then it's fine. It doesn't apply to them. And when it comes to futures, there are margin requirements, so you gotta take note of the initial margin required as well as maintenance margins required. To put in simple terms, the initial margin is the amount of money you need to deposit to open a position. And normally initial margin would be higher than the maintenance margin. Okay? What is a maintenance margin? It's basically the minimum balance to keep the position open. Otherwise, you're going to get a margin call. And the margin is normally 2 to 7% of the value of the contract, depending on the commodity. So, to put in simple terms, margin is kind of like a down payment for the transaction. For any investor or trader who want to trade futures, they will need to deposit cash as margin. So, again, you can go to the CME website and then you can click on this margins tab over here. Then you'll be able to see the maintenance margin required, and this is for Euro FX futures. So aside from the specs, also check the maintenance margin required. So for Euro contract, again a recap, one standard contract is about 125,000 units, which requires about 2,300 USD of maintenance margin to keep the position open. Okay, so when it comes to Euro FX futures, the ticker symbol is 6E, product code is 6E. And let's go through a calculation on how much money you can make in the event you bought into a futures contract and then it goes up. Okay, so let's say today you bought Euro futures at 1.7000 and then it goes up to 1.08750, for example. So you take the difference and then you get 0.01750. Let's say you bought the standard futures contract. What is your profit? Remember, the standard contract has 125,000 units, right? Times 0.01750. And then you get your profit, which is 2187.50. So that's a lot of money in the short term. But this position, if it goes against you, you're going to lose a lot of money too. So that's why I tell you to not over leverage. Okay. Mark to market, you come across this term too. Basically, it's the daily adjustment of the contract's value based on market price changes. You don't need to worry too much about this. It's just a term that is commonly used in futures. And by now, you should know that it is traded in a futures exchange. Basically, it is the marketplace where the contract is traded. And Chicago Board of Trade is the leading futures and futures options exchange. Most futures markets are not open 24/7, but they are open for nearly 24 hours a day. So you gotta check the timings too. Remember that in the spec. And in a lot of cases, there's going to be a market maker in the exchange who are there to quote buying and selling prices. Basically, having a market maker allows the futures markets to have more liquidity because basically they act as a clearinghouse for the trade orders. Okay. So how to start futures trading? Of course, the first thing you gotta do is to open a futures trading account with a good broker, then deposit a good substantial amount of margin as collateral so that you wouldn't get margin call that easily. Then you can place buy orders. Try to avoid shorting futures, like I said just now, and your daily settlements will be through mark to market, and then you close the position before expiry so that you can roll over to the next contract. So you can understand that it is the exchange that will determine the date, quantity, quality of the underlying asset. But when it comes to entering, you can enter using a market or limit order. And you got to understand that once a trade has been completed, the market participants, meaning the traders, they are obligated to the exchange rather than to the other party. So let's say if the farmer just now decides in July to end his September contract, then he's going to buy back the same number of September contracts that he previously sold in the example just now, and the two sets of contracts, they are going to cancel each other out. So basically, the farmer would have liquidated his contract. Because he sold his contract earlier than expected, if the price in July is greater than the price he bought it, then he's going to lose money. But if the price is less, he's going to make money. Okay, so some of the factors that affect futures prices include supply and demand, just like Forex. Stocks is affected by supply and demand forces, cost of carry. Now, this is basically the storage cost insurance for commodities only. Also depends on interest rates, seasonality for commodities. If you watch my gold seminar video, you realize that gold prices are affected by seasonal factors, market sentiment, as well as global economic factors. So some of the risks you need to take note of: avoid over leveraging because market volatility can lead to unexpected margin calls. Don't overtrade, don't break your trading plan. Also, don't trade the markets which are not liquid because the lower the liquidity, the higher the volatility, and the more expensive the spread. Gap risk as well because futures is not really 24/7. So that's why a lot of futures trader, they are going to day trade because it's same for stock market. Okay, because stock market, it closes at the end of the trading session. Let's say today it closes here, then tomorrow it opens here. Let's say if you bought this stock, then you put your stop loss here. When it opens here the next day, your stop loss wouldn't get triggered. Okay, leverage, make sure you don't over leverage because while it may magnify your profits, it can also increase your losses. Okay, but thankfully, forex has a higher leverage as compared to futures. Okay, I've seen some forex brokers offer this. Please don't do this. This is crazy. Okay, futures brokerage firms, make sure you pick the good ones, and they are sometimes referred to as futures commission merchants. Basically, they are just like forex brokers, stockbrokers acting as intermediaries between customers and futures markets. And just like stock brokerage firms, they come in the form of full service firms, which is more expensive, and discount firms. If you're a beginner, you can go with this. Okay, some futures trading strategies which could overlap and be similar to forex stock strategies. Example, trend following, momentum based, volatility, fundamental, hedging, range bound. Now, because this is a beginner course, I wouldn't go into detail into these strategies. If you want a more detailed video about this, let me know. But only for my supporters, because there are some entitled people who come to my content and complain on the fact that how come the stuff that you present are available for free on Google. Well, isn't this cost free? The thing is, a lot of people don't value free stuff nowadays. That's why don't complain when gurus start to charge money for their courses, because based on my experience, most people, they are entitled when they get free stuff, they don't value it, and they don't become grateful. If you're that kind of person, you can stop watching, because I'm not here to serve you. So for my supporters, one homework for you, go through these websites, Chicago Mercantile Exchange, because this is where you get all these specifications from. And for charts, you can just use TradingView, easy to use. And for education, you can look at the NFA Futures, National Futures Association website. And I also post more futures video in the future too. And for prop trading, you need capital for futures trading. Then you can consider Apex Trader. Funding, I'll put the link in the video description below as well as in the pinned comment. Now beware of fake accounts, because if you found a Korean full account chatting with you, talking to you back and forth, that is not me, okay? That is not me. I'm also not on Telegram, not on WhatsApp. Those are all fake accounts with my picture. So always double check. If you can't even tell, don't become a trader, okay? If you got questions, then you can email my team, my manager at this email. Then my Instagram, make sure you follow the right ones, because there are a lot of fake ones there too. They could just add one extra symbol, one extra word over here, and then it looks similar. So with that, may the peace be with you. Talk to you in the next video.